Today, we will focus on the weekly analysis of financial markets, particularly on Friday's unemployment data, the expectation of interest rates in light of Powell's speeches, and graphical analysis of major global indices. This week, Powell appeared before the U.S. Congress to deliver the semi-annual report and was quite tough, especially when he said that if all the data indicated that faster tightening was needed, they were ready to increase the rate hikes. This obviously caused very strong expectations for the next rate hike and Fed meeting of 0.50. Another thing Powell said was that the Fed would not help Congress if they were to decide to exceed the debt ceiling and therefore risk defaulting on the U.S. In this case, Biden proposed a minimum tax of 25% for billionaires and in particular, would like to return the tax burden for capital gains from 20% to 39.6%. These statements obviously impacted expectations for interest rates. Just a month ago, the probability of a 50 basis point hike was below 10%, but now there is almost a 70% probability of a 0.50 hike. How to interpret this? Well, probably if I were the Fed, I would think twice about making such strong hikes, because the current rate hike is creating a domino effect. After the failure of Silvergate Bank this week, it was also the turn of Siliconvalleybank. I have already created a specific video on these two banks. The problem also lies with banks in general because they hold many bond securities that are important to the bank's own equity. Therefore, if there is an increase in interest rates, the bonds lose value in terms of price and also in terms of bank equity. The restrictive monetary policies implemented to combat inflation are not going well, as inflation is far from being defeated. However, one must be careful because trying to cure one problem may risk creating a domino effect. Regarding the macroeconomic data for the week, there were inflation data for Germany, which was a non-event, so it remains very high. The GDP of the euro area is still strong, around 1.8%, indicating a strong economy. There were some conflicting data regarding confidence, but it's okay as we're talking about volatile data. All eyes were on Friday for the U.S. unemployment data. There was an increase in expectations for average hourly earnings, which is not good news in terms of inflation. Unemployment rose more than expected, as the market expected a stable 3.4% figure, but it turned out to be 3.6%, indicating a slight worsening. However, we know that in the job market, there's good news and bad news. In this sense, the market had found some strength on Friday, but as seen here on the right, the market then fell quite clearly at the end of the week. Now let's move on to the graphical analysis and start with the Bund. The Bund has recovered, but I believe we are in an accumulation phase. If we look at the market momentum, there are some nice divergences. Despite the expected interest rate hikes by the ECB, there is still a significant distance from the moving average. A return to the average could be possible, but I think it's more related to a fear factor. If a situation were to worsen, it is normal for the Bund with a yield of around 2.5% to be attractive to savers as a safe haven. Therefore, we can expect a recovery attempt by high-quality government bonds. As for Italy, this is a historical view. Keep in mind that Italy does not take into account earnings, so it's a cleans index. As for the earnings that are accounted for, it can be misleading as it doesn't tell the full story. Nonetheless, we have arrived at a similar level to the maximum in 2008, with our dividends included. There is a significant distance from the moving average, which tends to act as a magnet and bring prices back to the average. Europe is not far from the situation created in Italy. Here we can see that we are at similar levels to 2007 to 2008. It is a weekly market, and the momentum is slowing down, which sometimes leaves room for fear. If we want, it's a market that's trying to break out in some way, but is struggling. The DAX in this case is daily, and as we've seen lately, it's been making a bit too many gaps. There's a significant battle going on between the bulls and bears, if you will. In this case, we're looking at a daily chart, and we can see some significant divergences. As for America, the Nasdaq is giving an ugly signal on the weekly chart as it's dropped back below the 200-week moving average, which is certainly not an encouraging sign. However, we know that America is still a driving force for other markets. Nonetheless, there are still some divergences that were good, if you will, for what's happening in technology. On the other hand, if we look at the chart of the Standard & Poor's, it's made that break that we didn't want to see. It's important that this key level holds. Powell's words haven't encouraged investors, so we hope there will be a reaction from now until the end of the month. Generally, the second half of March is positive, so we remain confident. It's normal for a return below this level, and as we can see on the weekly level, the MACD is crossing over, but we'll have to wait and see how it evolves. Regarding the dollar, obviously an expected or unexpected increase in interest rates of 0.5% made it a positive week. If the spread between European and American interest rates were to widen or remain stable, we expected a more dovish Fed. It's true that there was an oversold phase on the dollar, and we had reached this ascending channel, so it could bounce back at this level. We'll see what the future trend of the dollar will be, whether it will continue to appreciate based on the interest rate differential between the euro and the dollar. In particular, you and the Japanese bank, which was the last to meet with the Fed and outgoing Bo president, resulted in nothing, but it's normal that at the next meeting, Japan will likely start raising interest rates, but there is also a yield differential to consider. As for China, Xi Jinping has been elected as president for the third term. Again, this is an unusual position for 3 consecutive terms in leadership. Regarding China, the trend continues to be upward with higher highs and higher lows. Key levels in diversification also apply to China in this case. This year, diversification is very important for all countries because there are very different policies to address the economy, so diversification is definitely a priority. In conclusion, I believe that keeping liquidity in your portfolio remains an interesting choice. It's not easy to make predictions as you can only predict as far as time allows, so it's best to have well-diversified portfolios and open scenario analysis to all options. Let's say we can view this period as walking on a frozen lake in spring, thinning ice. So, let's hope it holds. While you've reached the end of the video, if you are interested in learning more about similar topics, here you will find other really interesting videos from the channel. Thanks for watching this video. Click on the like button if you enjoyed it, and do not forget to subscribe in case you didn't. See you on the next one.